Greetings everyone. Coming back to the capital gain, in continuation to our first session, let us continue to the next part, that is, as we discussed, short-term capital asset when they are held for 12 months. Today we are going to start with the 24-month rule. So under the Income Tax Act, here when we talk about not the liquid asset but other kinds of asset, for example, land, building, etc. So under the Income Tax Act, the classification of a capital asset as short-term or long-term is, as already said, that it is determined by the period for which that asset is being held. So while certain financial assets enjoy a reduced holding period, another important category of asset is governed by 24-month holding period. Now, this rule primarily applies to unlisted shares and immovable properties, such as land, building, house property, etc. In the case of these assets, if they are held for 24 months or less, then they are treated as short-term capital assets. Otherwise, if it is beyond 24 months, then it is a long-term capital assets. And obviously, both will attract a different tax treatment then. So a significant amendment actually was introduced with effect from the financial year 2017-18, whereby a holding period of immovable property was reduced from 36 months to 24 months. This change was made to encourage the investment and improve the liquidity in the real estate sector. As a result, what happened? The properties held for more than 2 years can now benefit from the long-term capital gain provision. So first, initially before 17-18, the period was 36 months, but now if you transfer it beyond 24 months, it comes under the long-term capital gain. Maybe let me explain it with the help of an example. Suppose consider a case where an individual, maybe you or I, we purchase a residential house on 1st June 2023 and we sell it on 1st May 2025. The holding period in this case is less than 24 months and therefore the property will be treated as short-term capital assets. Conversely, if the same property is sold after holding it for more than 24 months, it would be classified as a long-term capital assets. Okay. I hope this is clear now. And similarly, in the case of unlisted shares, because initially we were talking about the listed shares, unlisted shares, if the investor acquires the shares of a private company and he sells them within 24 months, then the gains will be treated as short term. If the shares are held for a longer duration, then they will qualify as long-term capital assets. So it is important to note here that 24 months rule is not universally applicable to all the assets. I hope this is clear. Certain movable properties such as jewelry, debt-oriented mutual funds and other similar assets do not fall under this reduced holding period, and they continue to be governed by the general rule of 36 months for classification as a long-term capital asset. So I think therefore if such assets are held for 36 months or less, they are to be treated as short-term capital assets. You have to be very careful while distinguishing between the categories of assets and their respective holding period. Okay. For correct classification, you must always examine the nature of the asset, the duration of the holding, and whether any special reduced holding period applies or not. So this distinction actually is very, very important because it directly affects the the tax liability and the computation of the capital gain. So I hope this is clear. So it's better, I always advise my student to learn the categories, the distinction part. Learn them up so that you're not confused and you do not wrongly decide the nature of asset, long term or short term. Coming to the long term capital assets, whatever we have discussed for short term, I think we extend the period and it is the long term. Under this, we can say that obviously, as already said, that if it is held beyond the specified minimum period or maybe exceeds the minimum specified period, then the whatever the threshold has been prescribed, it will be long term, obviously. Okay, but the classification of the of any asset as long term is important because it determines the method of taxation, because long term or short term both have different methods. Okay, because here in long term we have the availability of indexation benefit and eligibility for exemptions under various provision. So as a general rule, I would say that a capital asset is treated as long-term capital asset if it is held for more than 36 months, immediately preceding the date of transfer. Okay, this actually rules applies to most capital assets, particularly movable properties such as jewelry, paintings, sculptures, debt-oriented mutual funds, and other similar assets. However, the law provides reduced holding period for certain category of assets. I hope you now understand that, recognizing their nature, their liquidity nature, and the role in the economy. So these exceptions are as follows. Maybe assets with 24 months of holding period. There are certain assets that qualify as a long term if held for 24 months, more than 24 months instead of 36 months. That is maybe unlisted share of any company or immovable property such as land, building, and household property. For example, if the residential house is purchased in June 2022 and sold maybe in July 2025, then the holding period exceeds 24 months. Obviously, it will be treated as long-term capital assets. I would say here that the variation in holding period reflects the nature of different assets. The financial assets that are frequently traded and highly liquid are given a shorter holding period, that is 12 months, while relatively less liquid assets like real estate, land, building, or anything, they are assigned as moderate period, that is 24 months, and other assets which do not fall under these categories, they continue to follow the general rule of 36 months. So, I would conclude here on the classification of assets. I would say that a capital asset becomes a long term or when it is held for more than maybe prescribed period, that is 36, 24 or 12 months. It is on the basis of the types of assets, and the obviously calculation is done accordingly, and your provision of taxation are to be followed accordingly. So I hope now, after such detailed and comprehensive discussion on long-term and short-term capital asset, it is clear to all of you. Now, continuing to this, let us have a more deeper understanding of this. As a general rule, any capital asset which is held for more than 36 months, immediately preceding the date of transfer, it will be treated as long-term capital asset. Okay. This rule actually typically applies to most movable assets such as jewelry, painting, debt-oriented mutual funds, and other similar properties. However, Here the law provides reduced holding period for certain categories of assets, recognizing their economic significance and liquidity. One important exception relates to immovable property. Capital assets such as land, building, and house property, they are treated as long-term capital assets if they are held for more than 24 months. This reduced period has been applicable from the financial year 2017-18 onwards, when the law was amended to encourage the investment and improve the activity in the real estate sector. So, in addition to immovable property, certain financial assets such as listed equity shares, listed securities, UTI, units of equity-oriented mutual fund, they are treated as long-term capital assets if they are held for more than 12 months. Okay. So while the 36-month rule remain general standards, it is very essential to remember that different categories of assets have different holding period threshold, namely 24 months or 12 months or 36 months. Okay. So these are some of the which we have already understood just now. Before proceeding to further concept, let us go for a very short question. Understand this. Here let us continue the gains or loss, whatever. Let us check it out, whether it is a gain or loss. So, when we are computing this computation of gain or loss, so first we will put it. Computation of gains for the assessment year 25-26. Okay. So the first point that we are going to put here, whatever, the selling price. So the selling price as per this question, it is rupees 2 lakh, which is sold on 20th October 2024. It is rupees 2 lakh. Okay. Then next item that we have to consider here is what is the fair value, market value of shares on the date of transfer. Here we will deduct that amount, that is because that is the cost price, but we always compare that what is the fair market value. He purchased the share actually on June 1st, 2024, he started a business as a dealer and he transferred the earning of the entire holding to the business. So here the market value of such share on that date was 1,60,000. But what was the 1,60,000? And but what was the cost for which he bought? It is 1,20,000. So the day on which he sold it, it was obviously we have to consider the market value here. Fair market value on the date of transfer was 1,60,000. So the gain that he had was rupees 40,000. The difference between 2 lakh and 1,60,000. Okay. After that, we have coming to the capital gain part. It is 1,60,000 was the fair market value. Okay. 1,60,000. But to him it costed 1,20,000. So cost of acquisition was 1,20,000. Okay. So what he is gaining on this? He is gaining 40,000, isn't it? Because he paid only 1,20,000. Whereas the fair market value fetch him 40,000 more. But he sold for 40,000 more over and above the market value also for rupees 2 lakhs. So what his total income will be? 40 plus 40, 80,000. Okay. I hope this is clear. This is how we always compute the capital gain on the capital gain or maybe the income on a short-term basis. No indexation, no other calculation. After understanding both the things, that is short-term and long-term capital assets and gain we will come later on. It is only the nature of asset. Now we come to understand the transfer, definition of transfer. Section 2 or subsection 47 of the Income Tax Act, it explains that transfer is a fundamental to the taxation of capital gain. Without transfer, obviously there will be no gain or loss. So capital gains arise only when a transfer of a capital assets take place during the previous year. Section 247 gives a wide and inclusive definition of transfer so as to cover not only direct sales but also indirect methods through which ownership or rights of the assets are passed on. So the law actually deliberately uses an expanded meaning to prevent tax avoidance by structuring the transaction in form other than outright sales. Let us understand in detail that what transactions will be called the transfer. First is the sales, any kind of sales, meaning the transfer of ownership for a price, monetary consideration, obviously. Exchange will be defined as a transfer not for money only, but for another maybe asset instead of money. And relinquishment means giving up or surrendering rights in any assets for maybe some purpose. So, for example, if Mr. A sells a plot of land for rupees 20 lakhs, this is a transfer by sale. If he exchanged this land for a flat maybe, then this is a transfer by exchange. Now, suppose if he gives up his share in property in favor of his brother or sister or son, whatever, that is relinquishment. I hope these three things are clear now. Sale, exchange and relinquishment. Okay. Then another point comes, another thing that is included under transfer is extinguishment of any right in an asset. That is, transfer will include the extinguishment, that is termination of the rights in the capital assets, even if there is no physical transfer. This is very wide concept, and it covers situation where ownership rights are destroyed or they come to an end. For example, suppose if there is a situation like cancellation of rights in shares, or there is a surrender of tenancy rights or buyback of shares by a company, this way. So, even though no traditional sale occurs, the right ceases to exist and hence it is treated as transfer. So, extinguishment is also treated as transfer. Next, we have the compulsory acquisition of an asset, and means compulsory acquisition. As I said, that when the government acquires any property under law, for example, there are certain infrastructural projects or development going on in the city, and for example, a highway or expressway or bridge or maybe any other thing, a metro station that is to be built up, and your land, the land that belonged to you or the house that belonged to you, that has to be taken up by the government. This is called compulsorily acquired by law. So, it is treated as transferred even though it is not voluntary. Okay, for example, another example, as I said, that highway construction by the government, it will be transferred as it will be treated as transferred in the year of receipt of compensation, whenever you receive the compensation. Similarly, we have conversion of capital assets into stock in trade. When the owner converts a capital assets into stock in trade of a business, it will be treated as transferred. However, the taxation will be deferred if the capital gains are calculated on the date of conversion, but taxed in the year when such stock is actually sold. For example, to make it more simple, I would say that suppose anybody converts a land, for example, capital, which was his capital asset, into his trading stock for real estate business, it will be treated as transfer. Okay. So, this is how the conversion is treated as transfer. The next item, we have transactions under section 53A of the Transfer of Property Act 1982. This covers situations where possession of immovable property is given to the buyer. Consideration is paid or maybe partly paid, but legal ownership is not yet transferred. No registered sale deal is there. That means legal ownership, no paperwork has been done. Even though the legal ownership transfers, such transactions are treated as transfer under income tax. For example, a builder gives the possession of a flat to a buyer under some agreement. It is a taxable transfer. Okay. So, this point is important enough. Next we have next point that talks about the transactions enabling enjoyment of immovable property. Any transactions that effectively allows another person to enjoy the property even without formal ownership transfer, it will be treated as transfer. This provision prevents tax avoidance through indirect arrangements. For example, maybe long-term lease arrangement, maybe power of attorney transaction, maybe arrangements where control benefits are transferred. Even if the ownership is not legally transferred, but the economic control is transferred, we will put it under the category of transfer. Next point talks about the maturity or redemption of zero coupon bonds. So, when these bonds are redeemed or they mature, it is treated as transferred. For example, suppose any investor, he purchases a zero coupon bond at rupees 50,000 and he receives rupees 1 lakh on maturity. Difference is taxable as capital gain, and then maturity is treated as the maturity amount will be treated as transfer. So, we can just say that the definition of transfer will include the traditional transfer, that is sale, exchange, etc. It covers deemed transfer, for example, conversion, possession-based transaction, extinguishment. Actually, the objective is to ensure that any transaction resulting in change of ownership or rights or enjoyment of a capital asset will not escape taxation part or taxation liability. So, we have to, while deciding whether a transaction is transfer or not, we must have these things very clearly in our mind, and we must always analyze whether the ownership or right are transferred or extinguished. We have to understand that. Means we should be able to analyze that. Then secondly, whether the possession or enjoyment is given or not. Thirdly, whether the law deems it as a transferred even without the actual sale. So, I would say here that this section defining the transfer, that is 2 subsection 47, it provides a very comprehensive and wide framework for identifying transfer. It ensures that capital gains taxation applies not only to direct sales but also to indirect, deemed and economic transfers, thereby preventing tax avoidance and ensuring the proper tax compliance. We have already talked about this. what is exchange of assets, sorry, relinquishment of the asset. It is clear to you. Let me give you a very key distinction between the exchange and relinquishment. While both are transferred, obviously, but they differ in nature. Exchange involves mutual transfer. Each party pays or receives an assets, whereas relinquishment involves a unilateral surrender of rights by one person. So, despite this distinction, both result in change or termination of ownership rights, which is the core principle behind the capital taxation of capital gain. That is, there has to be a termination of ownership, or maybe ownership changes to passes on to somebody else. So, to include the exchange or relinquishment within the definition of transfer, it reflects a very broader principle. That is, any transaction that results in the transfer, substitution or surrender of ownership rights in a capital asset is taxable whether or not money is involved. For computation purpose, I would say in exchange, consideration is equal to the fair market value of the assets received, whereas in relinquishment, the consideration will be equal to amount that is received, if any. If no consideration, practical computation issues may arise, but it is still treated as transfer. Okay. So, we can say that here that exchange and relinquishment significantly expand the scope of transfer under section 2, subsection 47. They ensure that capital gain taxation applies not only to traditional sale transaction, but also to non-monetary exchange and voluntary surrender of the rights. So, maybe to understand or maybe to decide better, one must have a very clear concept in the mind how to, understand a transaction that might result in a change, substitution or surrender of right, because this is, a very key determinant in identifying a taxable transfer. Okay. So, next is how to calculate the short-term capital gain and long-term capital gain. After understanding very comprehensively the difference between short-term capital asset and long-term capital asset, it is now that we move on to understand how to compute the gains and losses respectively of both the short-term capital and short-term and long-term period. But we stop here for this session, and we'll continue to understand the calculation part and methodology in the next session. Thank you.